So we're now going to hear from the buy side, and the title of the next session is Shift in Risk from Sell Side to Buy Side, and I'm extremely interested in this panel as I think the shadow banking sector in general will be covered. So without further ado, I will introduce Lev Brodovsky from Star Mountain Capital, who will be our moderator. Sanjay Sharma from RBC Capital, Josh Smith from GSO Capital, Blackstone, and finally Michael Fox-Rabinovitz from Strategic Streams. So I will hand it over to you.
Thanks very much. Great to see everybody. I want to first of all thank Quantifi for putting this together. It's a great event. We'll have some nice discussions. So it's interesting to start with. Everybody's asking me about what are we going to talk about, and it's a broad topic. And basically, if you look at your brochure, the title right here, right, sell side pain, buy side gains. That's what we're going to talk about, right? But rather than having everybody give a presentation, I thought it would be helpful to set the stage a little bit, and then we can have a discussion where we'll go through different topics and talk about how this concept of shadow banking is impacting different industries and different players, where the risks are and how we deal with them. No big presentation here, just 2 slides, right? And these are examples of the kinds of trends that we currently see in the credit markets in particular. So in this example, we're looking at sub-investment grade corporate credit loans and who's holding that credit over time, right? And if you look at it, it's basically got domestic banks, foreign banks, finance companies like CIT, and there's institutional and securities firms, right? And what's happening? 87% is now held by institutional players. So non-investment grade corporate loans out there, the bulk is held by institutional players. Who are institutional players? Well, it's not banks, it's all the other players that we're familiar with. It's BDCs, it's CLOs, it's different kind of funds, including mutual funds, closed-end funds, and so on. The trend is compelling, right? And we're not talking about a very long time, but it's definitely a transformative type trend. This is slide number 1. So this is a more recent chart. This is a Thomson Reuters LSTA conference where they basically took a look at leverage in corporate lending. And they basically said, well, if you increase the leverage, who's out there providing loans? The borrowers are becoming increasingly more aggressive, pushing for higher leverage. They want to finance more and more of what they're doing with debt. And who's out there providing that? You can see that both on sort of the senior level and the total debt. Once you start getting to sort of high leverage where the market is right now, banks are stepping out and non-banks are stepping in. Right? And this is what's going on now. So this is not sort of this is this quarter. It's a circle. So these are the kind of 2 things that's just going on in corporate credit. And so what I thought we could do is, given that everybody's from a different type of institution, we talk about how we're seeing things change when it comes to shadow banking, non-regulated banks coming in, and have a debate, discussion, right? So I want to start kind of with what I do, and then we can go one by one, and everybody can chat about where everybody is. So I'm with Star Mountain Capital. provide financing, usually high yield financing, to what most people call lower middle market companies. These are companies with EBITDA between $1 million and say $7 million. So it's kind of right there in the middle. So we're, for example, Michael's company would provide financing to small companies below this, and for example, Blackstone would provide financing above that. So we're sitting pretty in the middle of that. And we'll provide this financing to U.S. firms across the country. So that's what we do. We're the sort of example, typical shadow bank. We have no banking license. We operate as a fund, and that's pretty representative of what we see in the industry. So, you want to start? Maybe Sanjay, you can talk about a little bit, kind of what you focus on.
Yeah, so I'm the Chief Risk Officer of Global Arbitrage and Trading at RBC in New York. We trade almost every instrument globally, including loans and CDOs, equities and volatility, mortgages, ABS, convertible bonds. And RBC is, one of the 10th largest banks in the world. It's been around for more than 100 years. RBC and the Canadian banking sector came, generally unscathed in the crisis. RBC is probably one of the strongest capitalized banks in the world. Tier 1 capital about double digits already, and through the crisis it has been there. And it is one of the largest banks by far in Canada. And it's a very large institution in the US as well. It's not well known that RBC is one of the largest capital markets player in the US. We are in the top 10 in the league tables. We do a lot of loan underwriting. And we have an investment banking business that provides very large financings to large corporate transactions. My own focus has been on credit for a number of years before I came here for 7 years. I was a Moody's credit analyst before that I was the chief credit officer, and covered finance companies and banks, including CIT, when I was at Moody's. And before that I was at Citi, almost 20 years ago, as a banker who did one of the first securitizations. Way back in 1989, we were the first securitizer. We were the first securitizers of municipal bonds, aircraft financing transactions in the early 90s, and I was fortunate to be part of that team. So that's my background.
Josh Smith, I'm the Chief Risk Officer at GSO Capital. We're the credit arm of Blackstone. So we're focused on, as Lev said before, non-investment grade credit, and our kind of pools of capital invest from, private mezz and what we call capital solution or rescue financing funds, to CLOs and BDCs, to some institutional hedge funds, ETFs. I mean, we're really at kind of at the crux of this notion of shadow banking. We fill the void that kind of regulatory environment around the banks have left, and we've seen a ton of demand for our products, and we've created investment vehicles for both an institutional investor base and increasingly a retail investor base to get into credit. We're the largest trader of leveraged loans on the street, and so we're very actively engaged in this area.
Michael?
Well, I guess we're unfortunately substantially smaller than RBC or BlackRock, but still both. Well, we basically deal in a very kind of niche area, which is gaining momentum nowadays, which is used to be called P2P, now it's switched to marketplace lending. So de facto, we also act as a small shadow bank to near prime and prime consumers via various platforms which exist. Most notably, as I'm sure a lot of you have seen, Lending Club and Prosper are the main avenues where we actually acquire our assets, and we also deal with various small businesses via the funding circle platform. So the idea here is we're able to construct portfolios, very quickly analyzing both consumer credits and small business credits, and using fairly advanced technology, kind of cherry pick the loans which are out there, and in a sense construct something which is fairly superior to something you would get by buying the index. So we kind of act as a small shadow bank for the consumers and a small shadow bank for the small businesses.
Great. Thanks, everybody. So the kind of the first thing I'd like to discuss is the growth. You know, we all see growth in shadow banking. I have seen property firms, somebody developing or buying a building in New York City. The first call is not going to a bank for any financing. It's going to an insurance company. Because all of a sudden, the insurance industry has become one of the largest real estate financiers. So we have a shift out of the banking system into the insurance world to finance real estate. You know, it's something that's not well publicized, but it's a trend that's taking place. What I would like to kind of ask each panelist is, where do they see growth areas in the world that they cover? From my perspective, for example, I see small mezzanine funds like SBIC funds. We get some government leverage, actively pursuing the space that we're in, and we work with them. And so you see the SBA every year approving more and more these small mezzanine funds who provide lending to small businesses. That's where I see a lot of growth. So wanted to kind of have everybody talk about where they see growth in this unregulated sort of areas. Sanjay?
First of all, I think unregulated is a better term. Shadow banking, I wouldn't use shadow banking as a term. I think it should be called non-deposit financiers. Unregulated by default or by design. I think shadow banking was a different concept where banks had created unregulated entities, the SPVs. That's what notion of shadow banking is. So let's think about non-finance, and I'm gonna twist the question a little bit. Where is the growth coming from? I think the growth is if we catch this economic cycle with respect to CapEx. Because right now the world markets, why are markets so bullish right now, even though with the October sort of whiplash that we saw. One reason is that Fed is the biggest market participant, whether you believe it or not, and that's why volatility is low as well, because the Fed is now the biggest bank in the world, possibly. And so when the Fed is not the biggest bank in the world, think about that. And banks have gone through these pains of settlements and things like that. What does the world look like then? If the CapEx, the capital investment, which I think is somewhat overdue in the U.S., picks up, the demand is going to be widespread across the board, and whether you look at property development, commercial real estate, you look at apartment houses, there's such a big answer to this question, because you have this home ownership declining, which means more apartment complexes have to be built. They have to be financed. You have more capex. You have any kind of new industry. Look at New York City. Yes, there is a lot of development in New York City, but if you look around and you think about, look at the capital plans for the city, I mean, the growth in New York City could be enormous. Even beyond what has been built so far, because the demographics are shifting. I mean, the shift outside of New York City is actually reversing. After 9/11, a lot of people moved out of New York City into the suburbs. Now that is actually reversing. People are moving back into the city. And so I would think that the demand is going to be broad-based. That answers your question.
That's perfect, thank you. Josh?
Yeah, I mean, look, for us, I mean, we've seen an incredible ramp in demand over the last 3 years. I mean, since kind of 09 and 2010, coming out, and like I mentioned before, the void created by the banks, and I think the demographic trends certainly play into this as some of a lot of the institutional money shifts from maybe an equity focus to more of a fixed income focus. Spreads, kind of rates being artificially low. We were sort of in the perfect spot in non-investment grade credit where we could offer yield, and obviously there's been a big reach for yield, and so we've seen incredible growth in demand, over those last few years. Lev and I were just talking before the panel started about our BDC and our BDC platform, and that was kind of started. It was a whim of a guy on the credit team in the first quarter of 09. They raised a little bit of money. It started out with trickling in, and they kind of hit the timing right. They put some good performance numbers together through 09, buying bank debt in the 70s, and it's grown to over $10 million on that platform. So just being kind of right place, right time. We've seen tons of inflow. So we've grown from being kind of having one multi-strat hedge fund to having independent, private, as I mentioned before, rescue lending, as hedge funds, our CLO business has grown. And now where the growth is, particularly in the institutional demand base, is for tailored credit products across those different platforms. So someone will come in and they'll want a hybrid of private-public strategies, and that's been our biggest growth areas in these separately managed accounts for large institutional investors. They come in with a big enough ticket, we can now customize something across that platform. But it's a function of being creative in the space. You kind of run up in some of these basic sleeves. Now you have to think of new ways to repackage some of those products and make and provide something that's a little bit differentiated. Now, for me as a risk manager, that's a challenging proposition. There's a challenge in terms of what we're offering, our ability to deliver that. We've now got more portfolios. There's allocation issues. There's a lot of issues that go along with that. And there are growing pains associated with that. But certainly there's been a lot of opportunity, and while there's still, I think, potential for growth, we're now seeing that start to plateau a little bit, and it's I think part of what I'm seeing from risk management now is that to meet this demand, we're getting into areas that maybe aren't part of our historical expertise. We're looking at more at structured products where our focus has historically been strictly in corporate and different types of credit products. So that's part of where we see where we're trying to grow our business is in products that are outside of what we've historically done, and trying to expand that platform to meet those kind of large investor demands for us to kind of be a one-stop shop for them.
Yeah, fair enough. I guess the space that we play in has really ballooned in the last several years. It started pretty small, with a couple of platforms just trying to disintermediate the banks, and there was a couple $100 million basically going through them. There was some demand, but very, very lukewarm, and there was tremendous kind of glut of supply relative to demand. Over the last couple of years, the situation has changed dramatically. We're looking at a market which is really about $1 trillion, which is all kind of the credit card and debt refinancings, and probably another half of that for small businesses that need loans, and banks being as risk averse as they are and have been, and probably continue to be. There needs to be new avenues and new, basically, purchasers of these assets. So, from our perspective, it's a huge market. It's growing by leaps and bounds. This year is only about $10 billion generated. So even if it grows by 10 or 20 times, it's still basically would not fulfill its potential. The idea of actually acting as a bank for consumers, as small business owners, is fairly compelling because, in a sense, what you can do is you can cherry pick a portfolio which a regular bank cannot do. There's all sorts of regulations. You cannot redline. You can do all sorts of things. But theoretically, you kind of get the best of both worlds. You get access to a pre-screened set of consumers or small businesses, which already passed muster and have been deemed creditworthy. And after you apply another set of analytics, you have this portfolio with outstanding risk-reward characteristics. And the institutional market is obviously catching up to it. Before it was initially it was just basically retail investors getting in there. Then down the road it was more kind of hedge funds and larger hedge funds. Now the banks themselves are oftentimes opting, instead of developing marketing arms, actually outsource the client origination to these platforms, mainly because of cost reasons. So we see this as a very kind of important growth area and kind of something that's a new paradigm. A lot more institutions are getting into the space. So I think it's niche but interesting.
Thanks. The next item I want to touch on is sort of the question of, so you look at the U.S., probably has more banks than any other nation. Why is it that banks cannot do this? What is keeping them from getting involved? And there are multiple answers to that. For example, here there's the famous 6 times rule where the Federal Reserve and other regulators in the U.S. said, look, if you cannot go out there and originate a loan that has leverage multiple of 6 times EBITDA on the debt. And so all of a sudden they put a kind of a hard line in the sand. You can't go above that. And obviously people know that you can do you can stay right below that, but you're not going to be very competitive. And that's seen in that graph. There are obviously other things such as new Basel rules and so on. And then there's competition, right? Just purely direct competition. And of course, there's also kind of disruptive technology such as these platforms. So I just wanted to kind of ask everybody, what is driving banks? What is keeping them from being engaged in this business from their perspective? Okay, so I'm going to start here.
I think there's a whole host of reasons beyond the ones that you described, and I would put them in 3 categories. The first one is cost of capital. Cost of capital is rising for 2 reasons. One is that banks are trading below book around the world, except Canadian banks. But maybe check, but I think Canadian banks trade on premium. And so if you're raising capital, which banks must, it's expensive capital, it's expensive equity capital. And then once you raise capital, there's a very expensive leverage ratio post-crisis. So cost of capital overall, you cannot lever above 10 times. You have the Fed restriction of leverage, and then there is the cost of liquidity, and so that we haven't sort of taken into consideration. Then there's the cost of stress testing, which requires even more capital to be kept. Basel rules penalize loans that are not investment grade. And so you have these global regulatory pressure of banks to somehow, eke out a dime on this business, a return on this. And then they have these bloated as in, banks are big, take the biggest banks, let's say the top 10 banks, you have, corporate jets and senior management and what have you. And then you have the legacy of all of these settlements that are going on. And banks also have deep pockets, so, borrowers can go after the banks. Misrepresentation of any kind of a deal, you can go after a bank and say, $100 million or whatever else. That may not be the case with the small providers. And finally, with embedded structures that banks have, cost structures, origination structures, cost of compliance for big banks is enormous, and we are only seeing the beginning of it. I don't know how many folks in the audience are dealing with Dodd-Frank, but then Volcker rule. But Dodd-Frank and Volcker, or Dodd-Frank is, it's not a well-publicized fact, but Dodd-Frank is more written regulation than all the regulation in the history of time preceding Dodd-Frank. So you have this new Dodd-Frank document. If you add all the pages, are more than all the regulation ever written. And so you have to deal with that. And there's an enormous cost to that. And then you have multiple regulatory authorities. And so if you put all of these together, it makes a very difficult proposition for somebody in the business and say, I want to originate small loans. And you say, well, where's the return? And that return right now is a moving target. And so I didn't sort of rest there. But still, if you run a nice and tight business, you could do that.
Yeah, I mean, look, it's hard for me to comment, not being on the sell side and having never been on the sell side, but certainly we see it. I mean, we're shown reg cap trades all the time, and banks trying to offload assets on their balance sheet in some structured format. I mean, we, and we're, it's those non-investment grade type loans that we're a natural home for, and we get inquiry on those types of portfolios all the time, and it seems to me it's as much the regulatory kind of rules that exist in addition to sort of the uncertainty. I mean, it's really hard. I mean, I think that there's still a lot of gray area in terms of how this is all going to shake out, and so there's certainly appears to be a reluctance on the sell side to really go after this business without knowing ultimately where this all shakes out and how and kind of the risk return, managing these type of portfolios.
Well, I guess in our world it looks fairly clear. So with the people that are being disintermediated by what we do are the commercial banks, and they're facing tremendous amount of hurdles in a sense. One is they need to kind of keep the brick and mortar structure, which adds to their cost. They need to comply to a whole host of regulations, which adds to their cost. They need to employ a lot of personnel for various reasons, which adds a lot to their cost. And plus, they need to comply to a lot of federal regulations where they cannot efficiently create a portfolio which is optimal and above the index. So what is happening here? You have these new entrants which de facto cater both to the changing paradigm of people being a lot more comfortable obtaining credit, and small businesses obtaining credit online in a kind of very straightforward and clean fashion, and at a lot lower cost than the banks. So basically, that's what we're seeing. The traditional banks are still not really suffering from the amount of volume that's being done via these avenues. It's still quite small, like 10 billion, as I mentioned. But slowly but surely, you have comments from them, and they're noticing this trend, and there's really not that much that they can do about it. But the smaller ones are going to jump in the bandwagon and de facto using these platforms as their outsourced deal sourcing and marketing avenues. So it's an interesting little world we're seeing, and I think it's only going to keep going in that direction.
I think I would just add, one point to that is that that model works well in the sense that you originate the loans, we buy the loans. I mean, you as origination shops will originate the loans. Banks are providing large ticket intermediation underwriting, which is the CDO model, making a point or 2 points and doing classical intermediation. And that works well, except for the requirement that is coming through that the originators have to keep a slice of the deal. And that could make it expensive. In other words, you have to say, okay, I'm buying $100 million of loans, I'm packaging them because I have the relationship, I have the balance sheet to buy that, which is, sort of pre-crisis mortgage model. I'll buy a $100 million portfolio, I'll pay you a premium, and I'll provide even financing for that pipeline. Then it comes to a bank packages, makes it into a $500 million deal, and then the bank has capital market and investors, insurance companies who traditionally could not do it, and so you sell it off. You make a point or two, and everybody's happy. That was the model before the crisis, except that banks then got such a lot of volume that they had to retain a lot of this and put it into the SPVs. So if they don't retain the risk, that model works really well in a manufacturing sense. You have somebody making parts for the jet engine, and Boeing is an assembler, or you have these auto shop, automobile manufacturers who are basically taking parts, assembling it and selling it off, and then taking care of it afterwards. So that model works well, but then it has to be done in a very controlled fashion, and there should not be a cost of regulation.
Thank you. Just a quick comment on innovation in space. I know there's people sort of complaining there hasn't been sufficient innovation after the financial crisis in the financial services industry. But I was wondering what the panelists see. So from my experience, we are looking, for example, to do what's called a CFO, collateralized fund obligation, where we pool a lot of income funds into a portfolio and securitize that. So I thought there was something a little different. These have been done before with private equity and hedge funds. Now we're going to focus kind of on credit funds. So the question for the rest of the panelists is, are they seeing anything of that nature as well? Sanjay, you want to start?
Yeah, innovation in that. So why don't I turn it from the other side? I'm speaking first on every question.
Sure. I guess I can speak to innovation, in the space that we play in. There's been, a tremendous amount of these platforms popping up, and I guess the innovative thing about it is there's a lot more assets and asset types that are being, not traded per se, but listed on these platforms with the secondary market. Not probably terribly far behind. You have anything from real estate, all sorts of real estate products. You have some mining rights. You have basically consumer lending. You have small business lending, and there's little features which are being wrapped around it, be it equity kickers, be it provision of multiple guarantors. So nothing terribly innovative from the perspective of general finance, but innovative enough from the perspective of this P2P space, trying to add bells and whistles and create a more bespoke and customized tranches to appeal to a whole variety of investors.
Yeah, for us, it's a challenging proposition. We're shown some different types of products. We're very conservative in that regard. We're very focused on fundamental credit, and we dabble very minimally in some kind of structured products, but we're really about vanilla credit and really corporate credit, and we don't stray much from that formula. So while we see things here and there, and occasionally something looks interesting, we almost never have to have the confidence to move ahead. Although I will say, we're getting more and more pressure just based on what's happening with spreads, money coming in, looking to put money to work on our BDC platform in particular. There seems to be a growing what's the right word? Maybe appetite to contemplate some of these products or investment vehicles that we historically wouldn't look at, which is concerning for me. And so I'm involved in those conversations, and making sure that that we know what we're getting into. But certainly, I worry about the whole tourist investor type of concept where we get out of our comfort zone into credit products that we may think we understand but don't have a lot of experience with.
I think that is really laudable. I mean, because ultimately, financial innovation is about tailoring the payoff from a very fundamental product to the heterogeneous community. Because there are only two kinds of obligations in this world. One is a loan and one is equity. I mean, you can have hybrid and preferred and convertible bonds, but either you have a principal and interest payment or you have a dividend payment. I mean, that's where it all starts. And so if you have a lot of innovation, and this is my favorite analogy, which is that think about a large bank. 30 years ago, a large bank had loans on its book and something else, just maybe some other stuff, and had deposits on the other side. And so you could easily compare what's going on. You could easily monitor what's going on. Now what you do is you put in a whole set of derivatives and all the other complexities, complex transactions on the asset side. At the same time, you have these complex funding mechanisms and deposits in capital markets and equity. And so for a risk manager, so for a risk professional, you have to put all of these separate transactions with separate dynamics into the sausage factory and come out with metrics that identify where the risks are. So you take all of this meat, you decompose it, and then you try to create something that is observable. It's a very challenging proposition. And so the more innovation you have, by design, the more complex it becomes to decipher what's going on. And then you have this liability structure. And so if you look at the deals that were done prior to the crisis, if you have sound loans in it, then it's great. So you're focused on fundamental credit. If you have sound loans, then the foundation is sound, and you can slice and dice and say, hey, you get this and you get that. But if you have this sausage factory that was created, prior to the crisis, where loans are going in and nobody cares, and you have a CDO and a CDO squared, that's when it just broke loose. And so innovation is great as long as you're matching the requirements of the investor and the requirements of the borrower. Somebody says, I need a 5-year loan. Give a 5-year loan, somebody says, I need to buy a 10-year asset. So you transform that into a 10-year asset, that's fine. As long as the focus is on two transactions, is it an equity transaction or a borrowing? So I think that's the caution. I mean, all innovation will always take place and it's healthy, but the focus has to be there.
Thank you. The next item I thought maybe we could talk about as a risk officers, we look at the risk across some of these areas. There are generals or macro risks to the economy. Is there an issue with the BDC world? It's grown so fast and it's become such a big player in providing credit to kind of middle market corporates in the United States. What happens if there's a disruption, right? These types of risks. Other risks to sort of specific institutions from these types of new what Sanjay called non-deposit financiers popping up all over the place. And finally, how do you assess these things and these risks and how do you mitigate them? Again, maybe start with Michael and just sort of talk about this.
Sure. I guess from our perspective, The biggest nightmare is this sustained kind of depression, sudden and then sustained. So do we really know what's going to happen to that in that scenario to portfolio consumer and small business credits? We can guess, we can run stress tests, we can kind of estimate, but we're not really quite sure. So as much as we'd like to be able to predict what happens in a scenario, and we do try to do that, I would say to our world that's kind of the biggest potential damage, which is unfortunately still not fully quantifiable. There's obviously others, some other geopolitical risks and things like that. But I mean, from our perspective, that is something we struggle with constantly. And while do not believe that something is going to occur in the foreseeable future, but once it does, that's something that's highly unpleasant for this world.
Yeah, I mean, look, for us, I mean, it's been well documented. I think that the sort of transformation from sell side to buy side that we're talking about, I think the biggest fallout from a risk perspective has been liquidity in our markets. And so, so that's our biggest challenge is understand, without sell side desks maintaining any inventory. It's fine when there's two-way markets and low volatility and stability. Actually, it's funny. We actually, even in this recent volatility, we were kind of confronted with the lack of liquidity in a way that I wasn't expecting, and that we had some portfolios that were actually running with fairly high cash balances, waiting for this opportunity spread. High yield spreads inside 400 was not a great time to put money to work, so we're running with higher cash balances. You get a little stress and volatility in the markets. High yield blows out 100 basis points. You're looking to put that money to work, and it's not there. I mean, you're getting the runs from the dealers, and you're trying to buy, and it's ones and twos, and you really can't get it to work. So it's evident, to us that liquidity is going to be an issue, or is an issue now, and certainly in a more severe bout of volatility. It's going to be an ongoing problem, and it's a tricky one to manage. We do our stress tests, and we'll look at our kind of our liquidity pipelines, and we canvass our trading team and ask them about liquidity, and then we assume that they're being aggressive with those, and that they won't be able to find as much liquidity. But you can measure it, and you can look at it against your timeline, but you can't really. There's not a lot you can do about it, and so it's one of these things you have to keep an eye on, and you have to and live with, and communicate to people when you think there's risk of not being able to meet a funding obligation if you run into a volatile period, and that that buffer is bigger now than it may have been historically, and I think so. Ultimately, I think the ultimate test of I agree with you. I'm not calling it shadow banking. I certainly don't feel like we're operating in the shadows, but in this non-regulated banking will be just in the next default cycle, right? And so, we'll find out, which structures are sound, which are resilient, and which aren't, and the liquidity is going to exacerbate that, that next downturn in the default cycle, and so, that's where our focus is, and that's where we really try to, like I mentioned before, stay close to home. Fundamental credit research, you might take a mark to market, but if you manage your default losses and the ultimate principal losses, regardless of kind of the investment structure you put around those credit ideas, that you should be able to manage through those down cycles. But certainly, some of these more innovative or newer structures, will be tested in the next default cycle. And I think one of the catalysts, I think, when you think about the time period we've been through, when you think about kind of non-economic forces, obviously we've been in an artificially low rate environment for for a number of years now. And so, where the natural level of rates would be, we could debate, but certainly it's higher than where they are. And so I think, and again, it's been well discussed and well documented, but I think that the next spike in rates, and particularly in short-term rates, and that may not be for 2, 3, or 5 years, but when that happens, and now you've got all of these, these floating rate instruments out there and rate risk in different pockets and different parts of this kind of banking and unregulated banking world, to see who's exposed to those risks and what that does to some of these structures is going to be, that's going to be the true test.
Personally, I'm very concerned about what might happen over the next 2 or 3 years, and let me lay the foundation. I think that not only that we have low or zero interest rates, which is resulting in economic growth, whether it's real or not is for anybody's guess. We also have an absolutely enormous support provided by the Fed, and that is in 2 directions. One is what is apparent. What is apparent is that Fed can buy any asset right now. Whatever they see, they could have bought in QE, so we have, including treasuries. So whenever they have seen demand, so we have this sort of vast sucking sound, sucking machine for anything that moves in markets. And that has been going on for 3 or 4 years. That's that we see. What we don't see is that the Fed is not hedging anything. The Fed is not concerned with, mark to market. And the Fed is not necessarily concerned with defaults and all that because it taxpayers' money on whatever it is. So imagine if the Fed decides tomorrow to say, within a week, we're going to blow out this balance sheet. So you have these trillions of dollars that will go into the market, and fine, that could be absorbed, but that has to be hedged. So everybody's going to run out and buy volatility to hedge it, right? So by not hedging, Fed is enormously short volatility, and that is not apparent. So that's why everybody says, hey, why is vol so low at 15? It should be at 20, whatever else. And that's because there's a big portion of assets that are not hedged. Because if they were at JP Morgan or Citi or RBC, whatever else, they would be hedged. And for hedging, you need to buy protection in the form of volatility, long volatility. So that's one element. The second element is that because of regulation, so you have this pillar that has been buying all of this. That's providing support, both psychological support and actual physical support, that we are there, we'll buy it, don't worry about it. Actually, one of the most scared, I talk to a lot of people at the Fed, the entity that is most worried about volatility right now is not us, it's the Fed. They don't want to see this volatility, so every time something happens to them, we are there and everything is fine. Because they are worried for this volatility. It's not the markets, because they are generally hedged. The second point is that banks have been handcuffed by Volcker, by Dodd-Frank. So if there is a dislocation, you won't have, as you said, sell sides going in and saying, I want to keep this inventory because I see value in this. So they're not going to go out and buy if there is a volatile period for whatever reason, and suddenly they say, okay, let's have $1 billion, we're a big bank, and let's buy these loans. They are handcuffed. They would not be able to do it by Volcker or Dodd-Frank or cost of capital, Basel, blah, blah, blah. The third part that is scary for me is the ETF market. Because for the first time in history of markets, you have ETFs that are traded every day, like equities, with tourist investors, that have highly leveraged loans, that have longer terms. It is not an equity ETF where you have, S&P 500 on one side and you're packaging it and trading it as one entity. You are trading loans every day through these ETFs. And so if the tourist investor says, I've done my journey, I need to go, so you have a selling pressure on the ETF, you say, I'm going to sell these, and so the ETF manager will have to find liquidity or liquidate the loans. So if they liquidate the loans, other ETF managers are not going to say, I see value and I'm going to buy those loans. So they have some liquidity lines and things like that. But eventually, these liquidity lines will only go that long. And so if there's a panic about loans, if there's a big default or, default rate goes up to 3 or 4%, I mean, one of the things that we did see in the crisis, beyond the top, Fannie, Freddie, and the automakers and whatever else, there was no general increase in defaults. There was no general increase except for residential and some commercial properties, but we didn't see corporate default rising. If that comes about and there's a panic, we could have a very big liquidity shock, and that keeps me awake in terms of who's going to be the liquidity provider. Is it going to be the Fed again and say I'm going to buy loans now, individually, or is it going to be somebody else because banks will be restricted?
I think we're good. Just one thing that I wanted to add to what Sanjay was saying, where I see from the sort of smaller loans and the loan market that I'm looking at, where I see potential problems and possibly a spike in defaults is in the energy sector. And the energy sector is fairly levered, not the big multinational energy firms, but once you start getting to sort of the oil service fields and other types of energy-related firms, there's going to be some pain, and we'll see a spike in defaults. If you, for example, look at the Credit Suisse leveraged loan index and just separate out the energy loans versus the rest of the index, you will see a historically high spread, right? So the market is already pricing in some serious trouble in that sector. Question is that going to create problems for the rest of the credit market? So that's kind of the concern that I've got.
Yeah, actually, we haven't seen it. It is interesting. I mean, it's a big focus for us that the energy in the high yield index or the broad-based indices over the last, I believe the statistic is over the last 12 to 18 months, it's gone from 10% to an 18% concentration in energy in high yield. So, all the new issuance has been to fund the exploration of the shale plays and all that type of stuff. So it's been. The high yield market in general is over concentrated in energy. This shock, if you looked in August, oil volatilities were at an all-time low. So no one was ready for this shock. No one was hedged, and you're already seeing it. As Lev said, there's a lot of pain in some high yield portfolios that are concentrated in energy. And you're kind of at a cusp. When we look at our energy plays, it's sort of you're always looking at sort of it's profitable at what dollar price of oil. When you start getting below 75, 70, a lot of these investments are not profitable. Now, oil prices have to stay low for a sustained period of time for that to really ripple through. Obviously they're very volatile markets, so people don't get too stressed over a week at 75. But if this drags out to a month below 80, there's going to be really snowball.
And we've seen this movement before in the 1980s. If you're around, you have the whole sector which is blowing up.
And related sectors supported.
Yes.
Okay, great. So I think we're good. I thought maybe we could take some questions from the audience.
No question.
Yeah.
I got a quick one to your last topic. Do you guys see sponsor strategic buyers coming in, buying distressed names in the energy space?
We haven't. I think we have a big energy investment team. This has kind of happened over the last couple of weeks, so I wouldn't have expected. And people are legitimately concerned. I mean, this really caught everybody. Our energy guys off guard. So I think people would need to digest it, and I think if things stabilize here, I would expect there to be some people with the confidence to come in and try to pick this stuff up. But like I mentioned before, with not a lot of liquidity, it's not that easy to go put a lot of money to work, even in the depressed names. I mean, once you start bidding, the price will go up pretty good. And I'm talking about high yield bonds and fixed income space, but it's not that it's not that easy to come in with a large chunk of cash and get it to work.
I would just add to it that you know, as you said, the energy price determines the EBITDA coverage, right? And so if you have an exploration asset or a, you know, under the ground asset, let's just call that, you know, below ground asset, which is energy itself. If you have a, you know, a secular decline in crude oil prices, which is not out of the realm of possibility of $50 a barrel, let's say, sustainably, you know, for the next few years, then it becomes very difficult for people to come in and say, I'll buy this asset.
So I think we're good. Just want to thank the panel here. You want to